What's up, future millionaires, or at least, future people who aren't living paycheck to paycheck and stressing about their portfolio of 3 meme stocks they bought on a whim. It's your favorite financially cynical Gen Z analyst here, and today, we're going to talk about something incredibly unsexy, something your TikTok finance guru will never tell you about because, frankly, it doesn't get views: index funds. Yeah, I know. Index funds? Sounds like something my grandpa would invest in. And guess what? Your grandpa's probably chilling on a beach somewhere, not refreshing Reddit every 5 minutes hoping his latest stonk recommendation moons. We're going to peel back the layers on why the quiet, consistent, utterly boring strategy of index fund investing absolutely demolishes the high-octane, dopamine-fueled circus of individual stock picking. And yeah, I'm going to bring the receipts. Let's get into it. Hashtag the allure of the get-rich-quick scheme, aka stock picking hype. Okay, let's be real. We all see it. The Instagram flexes, the "I turned $1,000 into $10,000 in a week" screenshots, the "you're leaving money on the table if you don't buy XYZ stock now" frantic energy in your feeds. It's intoxicating. It taps into that primal human desire for shortcuts, for the cheat code to financial freedom. You see someone shilling a hot stock or a revolutionary new company, and you think, hey, maybe I can be that person. Maybe I can beat the market. Maybe I can finally escape the soul-crushing grind of adulthood by becoming a day trading savant. Spoiler alert, you probably can't. And before you come at me in the comments, let me explain why. The entire industry of active stock picking is built on the premise that you, or some highly paid fund manager, can consistently identify undervalued assets or predict market movements better than everyone else. This is called alpha, the holy grail of outperforming the market. Sounds great, right? Except, historically, it almost never happens consistently. Think about it, who are you competing against? Professional traders with supercomputers and direct access to market data? Algorithms making decisions in milliseconds? Or maybe that guy in his basement whose research consists of scrolling through Reddit threads? The market is a fiercely efficient beast. All available information is rapidly priced into stocks. To beat it, you need a sustained informational or analytical edge that almost no retail investor, and very few professionals, possess. And let's not forget the transaction costs. Every buy, every sell, every oops, wrong pick, let me cut my losses move comes with fees, commissions, and often, less favorable bid-ask spreads. These tiny cuts bleed your portfolio dry over time. Plus, the tax implications of short-term capital gains, but we'll get to that delicious slice of pain later. Hashtag index funds, the unsexy truth that makes millionaires. So, if stock picking is mostly a fool's errand for 99% of people, what's the alternative? Enter index funds. Gasps. I know, groundbreaking. But hear me out, because this is where the quiet wealth strategy truly shines. An index fund, or an exchange-traded fund, ETF, that tracks an index, is literally just a basket of stocks designed to mimic the performance of a specific market index. The most famous one? The S&P 500. It holds stocks of 500 of the largest U.S. companies. When you invest in an S&P 500 index fund, you're not trying to pick the next Apple or the next Amazon. You're buying a tiny slice of all of them. You're betting on the collective growth and innovation of the entire U.S. economy, not on your ability to predict which specific company will win. Why does this work so well? Diversification, baby. Instead of putting all your eggs in one fragile, speculative basket, you're spreading them across hundreds, sometimes thousands, of companies. If one company tanks, your overall portfolio barely blinks. If the entire market tanks, which it does sometimes, welcome to investing, you know that historically, it always recovers. Always. Then there's the cost. Index funds are passively managed. There's no fancy fund manager with a corner office and a proven track record, that probably cherry-picked its data points. The fund simply buys and holds the stocks in the index. This means incredibly low expense ratios. We're talking fractions of a percent, often 0.03% to 0.15% annually. Compare that to actively managed mutual funds, which can charge 1% to 2% or more. That seemingly small difference absolutely eats into your returns over decades, easily costing you tens, even hundreds of thousands of dollars. ###the math doesn't lie, fees, taxes, and behavioral blunders. Let's get down to the numbers, because numbers, unlike your friend who told you to YOLO into Dogecoin, don't lie. Imagine two investors, both starting with $10,000 and investing $500 per month for 30 years. Let's assume a reasonable average annual market return of 8%. Investor A, the active stock picker / high-cost fund guy. Let's be generous and say Investor A matches the market's 8% average return before fees. But wait, he's either actively trading, incurring transaction costs, or in a high-cost actively managed fund, 1.5% expense ratio. So his net return is more like 6.5%. Investor B, the boring index fund investor. Investor B invests in an S&P 500 index fund with a 0.05% expense ratio. His net return is 7.95%. After 30 years. Asterisk Investor A, 6.5% net approximately $600,000. Asterisk Investor B, 7.95% net approximately $850,000. That's a difference of $250,000. For doing absolutely nothing smarter, just choosing the cheaper, more diversified option. And this doesn't even account for the behavioral errors. Active stock pickers are notorious for buying high, FOMO, and selling low, panic. Index fund investors are inherently disciplined by the set it and forget it nature of their strategy. Now let's talk taxes, because Uncle Sam always wants his cut. When you're actively trading, you're constantly realizing short-term capital gains, which are taxed at your ordinary income rate, often much higher than long-term capital gains. With index funds, especially ETFs, you rarely trigger taxable events until you actually sell decades later, taking advantage of lower long-term capital gains rates or even avoiding taxes entirely if held in a Roth IRA. It's not just about returns, it's about peace of mind. Are you an expert at charting candlestick patterns? Do you have insider information on upcoming mergers? No. Then why are you playing a game rigged against you? With an index fund, you don't need to check the news daily, you don't need to stress over quarterly earnings reports, and you definitely don't need to listen to some guru telling you to buy the dip on a company you've never heard of. You just buy, hold, and let the magic of compounding and economic growth do the heavy lifting. ### implementing the quiet strategy, your roadmap to not being broke. Alright, you're convinced, or at least less skeptical. How do you actually do this? It's laughably simple. 1. Open a brokerage account * Schwab, Fidelity, Vanguard, M1 Finance, pick one. They're all fine. If you're starting with small amounts, look for ones with no trading fees, which is most of them now, thankfully. 2. Choose your weapon, aka index fund. For most people, a broad market index fund is the way to go. *S&P 500 ETF, e.g., VOO, SPY, IVV tracks the 500 largest U.S. companies. Excellent core holding. Total stock market ETF, e.g., VTI, ITOT broader than S&P 500, includes small and mid-cap companies. Even more diversified. My personal fave. International stock market ETF, e.g., VXUS, IXUS. Don't neglect the rest of the world. Diversifies beyond just the U.S. economy. Bond ETFs, e.g., BND, AGG. As you get older or more risk-averse, adding a small percentage of bonds can stabilize your portfolio. 3. Automate your investments. This is crucial. Set up an automatic transfer from your checking account to your brokerage account every payday. Whether it's $50, $100, $500, whatever you can afford. This is called dollar cost averaging, and it's brilliant. You buy more shares when prices are low and fewer when prices are high, smoothing out your average purchase price and removing emotional decision-making. 4. Forget about it, mostly seriously. Check in maybe once a quarter, or annually, just to rebalance if needed. Resist the urge to tinker. Resist the urge to panic sell during a downturn. Downturns are when you want to be buying, remember? The market always recovers. This isn't just about money, it's about your mental health. Imagine not having to stress about every tweet from Elon Musk affecting your portfolio. Imagine having hours of your life back that you'd otherwise spend doom-scrolling financial news or getting FOMO from some dude's sick gains post. Index investing gives you that freedom. #### when might stock picking make sense? Spoiler, not for actual wealth. Okay, look, I'm not a monster. I understand the appeal of stock picking. It's like a game. And if you want to play, go for it. But understand what it is, a game, a hobby, maybe an educational experience, not your primary wealth-building strategy. If you absolutely must scratch that itch, here's how to do it responsibly. Allocate a tiny percentage ***, no more than 5 to 10% of your total portfolio. This is your play money. If it goes to zero, it should barely impact your overall financial picture. Diversify your play money **, even with your speculative bets, try not to put it all into one company. Spread it across a few individual stocks. Have an actual thesis *, don't just buy because someone on Reddit told you to. Do your own research. Understand the company, its financials, its industry. Treat it like a mini business investment, not a lottery ticket. Accept the high probability of failure *, you will probably lose money on some, maybe most, of your individual stock picks. Be okay with that. Learn from it. But for the vast majority of your money, for your retirement, for your house down payment, for your kids' college funds, stick to the boring, reliable, wealth-generating power of index funds. You'll thank me later. Conclusion. Embrace the boring, achieve the extraordinary. So there you have it. The secret isn't a secret at all. It's been staring us in the face for decades. The quiet wealth strategy of index funds isn't flashy, it won't make you an overnight sensation on TikTok, and it probably won't impress anyone at a dinner party, unless they're also quietly wealthy. But it works. It consistently works better than almost any alternative for the average investor. In a world obsessed with instant gratification and high-stakes drama, choose the path of disciplined, low-cost, broadly diversified investing. Choose to be boring, and watch your net worth become anything but. Now, if you actually found this unsexy deep dive helpful, hit that like button, subscribe for more truth bombs, and let me know in the comments, are you team index fund, or are you still chasing the dragon of individual stock picks? And remember, stay cynical, stay smart, and for the love of all that is financially sound, stop taking advice from people who started their YouTube channel last week. Peace out.